Hey everyone, welcome back to Corporate Decoder. Today, JATT II Acquisition Corp just filed an 8K announcing their initial public offering, and I am seeing a very common playbook that investors need to understand. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing marks the official debut of JATT II on the public markets after its IPO, and it's packed with details about how they are raising money and who is involved. So, what exactly is JATT II Acquisition Corp? Think of them as a special kind of company, often called a SPAC, or a special purpose acquisition company. Their whole business is to go out, find a private company they think is a good investment, and then merge with it to take that company public. They are essentially a shell company looking for a target to acquire. The big news here is that on the 20th of April 2026, JATT II Acquisition Corp completed its initial public offering, or IPO. This means they started selling their own shares to the public for the very first time. They offered 6 million ordinary shares with a very tiny par value of just $0.0001 each. That's almost nothing. The price for each of these shares was set at $10. These shares are now trading on the Nasdaq under the ticker symbol JATT. So just from selling those 6 million shares at $10 each, JATT II pulled in a massive $60 million. That is the money they have to work with to find and acquire that target company. Now here is a common move. The investment banks that help sell these shares, known as underwriters, have an extra option. They can buy up to another 900,000 shares within 45 days, still at that $10 price. If they exercise this, it means another $9 million could come into the company, bringing the total to $69 million. This is often called a Greenshoe option. When a company goes public, a bunch of agreements need to be signed. JATT has several key ones here. These are basically the rule books for how the company will operate and how investors' money will be handled. First up is the Underwriting Agreement with Guggenheim Securities. This is the formal contract with the investment bank that managed the IPO. It lays out all the terms and conditions of the stock sale. Then there is a letter agreement involving the company. It sponsored JATT Ventures II LP and all the officers and directors. This likely covers their commitments and responsibilities, especially regarding how many shares they own and are willing to sell. This is a really important one for SPACs. The Investment Management Trust Agreement is with Continental Stock Transfer and Trust Company. It details how the $60 million raised from the IPO will be held in a trust account. This money is meant to be used for the acquisition. The Registration Rights Agreement gives certain shareholders, like the sponsor, the right to have their shares registered with the SEC so they can be sold publicly. This is common for early investors. There is also a Private Placement Shares Purchase Agreement between the company and its sponsor. This is where some shares are sold directly to the sponsor, often at a different price or with different terms than the public offering. An Administrative Services and Indemnification Agreement is also listed. This usually means the sponsor will provide services to the company, and, in return, the company agrees to protect them from certain liabilities. Finally, there are indemnity agreements for each officer and director. This is standard practice, agreeing to protect them from lawsuits related to their roles. Now, let's dive into item 3.02. This section talks about unregistered sales of equity securities. This is where they sold shares that did not go through the full registration process required for a public offering. Right when the IPO closed, the company sold 300,000 of those ordinary shares directly to the sponsor, JATT Ventures II LP. They paid the same $10 per share, meaning another $3 million was raised through this private sale, bringing the total cash raised to $63 million. This private placement is a common way for sponsors to get a stake in the company. However, these shares come with some restrictions. For example, these specific shares cannot be sold for 30 days after JATT II completes its business combination, which is when they merge with another company. This is to prevent immediate selling pressure from early investors. They do get registration rights, meaning they can eventually force the company to register their shares for public sale. A key point here is that the sponsor has agreed to waive their redemption rights for these private placement shares. What does that mean in a typical SPAC if the company doesn't merge within a certain time frame? Shareholders can often choose to get their initial investment back or redeem their shares. By waiving this right, the sponsor is showing strong commitment. This waiver relates to situations where the company might not find a target within the usual 24-month period. The sponsor essentially says, "We trust you'll find a good deal, and we won't ask for our money back early for these shares." This provides more stability for the company as it searches for a merger target. Next up is item 5.02, which covers changes in directors and officers. This often happens around an IPO. On the 16th of April 2026, just before the IPO, 4 new directors were appointed to the board: Mr. Verinder S. Badial, Mr. Christopher Sterrell, Dr. Arjun Goyal, and Dr. Jonathan Cluft. The filing emphasizes that these directors are independent. This is important because it suggests they don't have a strong financial tie to the company other than their board position. This independence is often required by stock exchanges. These new independent directors have also taken on key roles on the board's committees. Mr. Bardia will chair the Audit Committee, Dr. Kluft will head the Compensation Committee, and Mr. Starrell will lead the Nominating and Corporate Governance Committee. These committees are crucial for overseeing the company's finances, executive pay, and board composition. Item 5.03 deals with changes to the company's foundational documents, like its Articles of Incorporation. On the 16th of April 2026, the company filed an amended and restated Memorandum and Articles of Association, often called the Amended Charter. This document outlines the company's structure, powers, and how it is governed. Since JATT II is incorporated in the Cayman Islands, this filing happened there. The terms of these changes are detailed in the company's original registration statement. Moving on to item 8.01, which is for other significant events. Here is a crucial point for SPAC investors. The full $60 million raised from the IPO plus the $3 million from the private placement, totaling $63 million, were placed into a trust account. This account is managed by Continental Stock Transfer and Trust Company. This money in the trust account is protected. It can only be used for specific purposes. First, to fund the business combination itself. Second, if the company fails to find a target and merge within 24 months, the money is returned to the shareholders who bought shares in the IPO. That is the redemption part. Or third, if shareholders vote to change certain rules around redemptions. This structure ensures that public investors are not left holding the bag if the SPAC doesn't find a suitable company to acquire. They also announced the pricing of the IPO with a press release on the 16th of April, and then another press release on the 20th of April announcing that the IPO had officially closed. These press releases are typically upbeat and designed to generate positive news. Finally, item 9.01 lists the exhibits filed with the report. This is essentially a table of contents for all the supporting documents. We see the underwriting agreement, the amended charter, various agreements with the sponsor, the trust agreement, and the press releases. And of course, the cover page interactive data file, which is for regulatory reporting purposes. The report is signed by Sumit Sidhu, the Chief Executive Officer of JATT II Acquisition Corp, dated the 20th of April 2026. So, what is the story here? JATT II Acquisition Corp has successfully completed its IPO, raising $63 million to fund its search for a target company to merge with. This is a standard SPAC playbook. The money is largely protected in a trust account, giving investors some security. The appointment of independent directors is a positive sign for governance. The key for JATT II now is finding and successfully merging with a promising private company. The performance of many SPACs post-merger has been quite poor historically, with many seeing significant declines from their initial IPO price. For example, many SPACs that merged in 2021 and 2022 have seen their stock prices drop 70 to 90% within a year or two. Investors in JATT II will be watching closely to see which company they choose and how that company performs once it is public. The management team's ability to identify a strong target and execute a successful merger will be critical. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.